Have you ever just looked at the stock market's daily swings and felt completely lost? I mean, it goes up, it goes down, the news channels are screaming, and it feels pretty much impossible to figure out which way things are really headed. Well, what if I told you there was a way to filter out all that noise? What if one of the oldest frameworks in finance could actually help us read the market's true direction?
That's the big question for any investor, isn't it? Are we all just caught up in some chaotic random system? Or are there underlying patterns, a kind of language that the market speaks that we can actually learn to understand?
Believe it or not, this is not a new problem. People have been trying to crack this code for well over 100 years, and through all of that time, one single framework has stuck around, offering a little bit of method to all the madness. It doesn't promise to predict every tiny up and down, but it does claim to help us read the most powerful force of all, the market's underlying tide.
And this right here is the beautiful core metaphor of the Dow theory. See, back in the late 1890s, Charles H. Dow and his followers realized something profound. They started to see the market not as a chaotic mess, but as an ocean. The real genius was separating all that chaos into three distinct movements: the powerful underlying tide, the secondary waves that push against it, and of course, the tiny daily ripples on the surface.
Okay, so if we're going to measure this big market ocean, what are our instruments? How exactly do we track the tide? Well, the Dow theory is very, very specific about this. It doesn't get bogged down looking at thousands of individual stocks. Instead, it focuses on just two key barometers of the American economy.
These are the only two tools we need. First, you've got the one everybody's heard of, the Dow Jones Industrials, or the DJIA. But the second one is just as important, though it's often overlooked, the Dow Jones Transports, the DJTA. The theory is absolutely insistent that to get a true picture of the economy, you have to look at both together.
And here's why both of them are so critical. The industrials, that's your 30 giant companies that actually make stuff. Think Apple, Boeing, Disney. They're the production side of the economy. The transports, on the other hand, are the 20 major companies that move all that stuff. The FedExes, the railroads, the airlines. They're like the economy's circulatory system.
So here's the crucial logic. One confirms the other. I mean, it's not enough for companies to just be making a bunch of products if nobody's shipping them, right? And it's not a great sign if the shipping companies are busy, but industrial production is stalling. But when both averages are moving in the same direction, that suggests a real, robust, and widespread economic trend.
All right, let's get back to our ocean. Now that we have our tools, we can really start to understand those three distinct movements that Charles Dow first identified. This right here is the absolute heart of the theory.
So, we have the tide, the waves, and the ripples. Each one operates on a totally different timescale and has a different level of importance. The secret sauce of the theory is learning to focus on the tide, understand the waves, and then completely ignore the ripples. So let's break them down one by one.
First up is the tide, also known as the primary trend. This is the big one. It's that huge, all-encompassing movement of the market that plays out over a long period. We're talking a year, maybe several years. This is either a bull market, where the tide is rising, or a bear market, where the tide is falling. For a Dow theorist, figuring out this tide is the single most important goal.
Next up are the waves, or the secondary reactions. Now, these are the sharp, tricky movements that go against the main tide. So, in a big rising bull market, a secondary reaction is one of those scary sell-offs that makes everyone panic. And in a falling bear market, it's a hopeful little rally that ultimately just fizzles out. These waves can last for a few weeks, even a few months. And honestly, this is what tricks most people into making bad decisions.
And finally, we have the ripples. These are the daily ups and downs, the hour-by-hour chatter, the stuff that financial news networks go crazy over. To a Dow theorist,
This is almost entirely meaningless noise. It's just the splash on the surface of the water that tells you absolutely nothing about the direction of the powerful tide underneath. The theory teaches you the discipline to just look right past it.
Okay, so let's really focus on that all-important tide. The primary trend can only be one of two things: a bull market or a bear market. So let's get crystal clear on what the theory says about these two major market environments.
So, a bull market is that rising tide. It's a long, broad upward movement in prices, and it's usually driven by good economic news and investor confidence. A bear market is the exact opposite, a long downward trend fueled by economic problems and pessimism. But the key thing to remember is that both of them are constantly interrupted by those temporary waves going in the opposite direction.
Now, what's really fascinating is that Dow theory breaks these tides down into three distinct psychological phases. A bull market usually begins with phase 1, hope. This is when the worst seems to be over, but most people are still scared. It's when smart investors see value and start buying. Then comes phase 2, growth. This is where prices rise as corporate earnings get better and the economic news improves. Confidence is growing. Finally, you hit the most dangerous stage, phase 3, euphoria. This is when speculation is everywhere, optimism is off the charts, and it feels like the party will never end, which ironically is often the biggest warning sign that it's about to.
And a bear market? Well, it has three phases too, basically mirroring that emotional journey, but downwards. It starts with phase 1, realization. This is when investors finally give up hope and realize the good times are over. They start selling. Then comes phase 2, panic. Selling picks up speed as the business news gets worse and buyers just seem to vanish. The final phase is despair. Here, even great companies are sold off as people just try to get whatever cash they can. Pessimism is everywhere. But it's right here, in the depths of that despair, that the seeds of the next bull market are quietly being planted.
So this all sounds great in theory, but how do you actually use it? How do the industrials and the transports tell you that the tide is really turning? This brings us to the most critical rule of the entire theory.
It is as simple and as rigid as that. A signal is only real, only valid if both the industrial average and the transportation average agree. If one is acting alone, it's just a false signal, a head fake. You need confirmation.
So what does confirmation actually look like? Well, imagine you're standing on a peninsula where you can see two different beaches of the same ocean. If the tide seems to be rising on one beach but not on the other, you'd be a little suspicious, wouldn't you? It's the same exact idea here. For a new bull market to be confirmed, both the industrials and the transports have to break out to a new high. For a bear market, both have to fall to a new low.
Let's walk through a classic bull market signal. So first, the market hits rock bottom, and then both averages rally up. Then you get a sell-off. That's our secondary wave. But crucially, it doesn't fall all the way back down to the previous bottom. This creates what's called a higher low. The final piece of the puzzle is when the next rally pushes both averages past their previous peak. That's a higher high. A higher low, followed by a confirmed higher high, is the textbook signal that the tide has officially turned up. And the bear market signal is just the perfect mirror image. After a peak, both averages sell off. Then you get a little hopeful rally, that secondary wave, but it runs out of steam before it can reach the previous peak. This is a lower high. When the next round of selling pushes both averages below their previous low point, that's a lower low. A lower high, followed by a confirmed lower low, is the Dow theory signal that a bear market is here.
So, after all that, what should we really take away from this century-old theory? What are the main principles that can act as a kind of compass for navigating the market's ocean?
Okay, so let's recap the big ones. First, the idea that the averages already reflect all known information. Second, the market has three movements: tide, wave, ripple. Third, those primary tides, the bull and bear markets, have three psychological phases. Fourth, and this is non-negotiable, the averages must confirm each other. And finally, a trend is considered to be in effect until a clear signal says it has reversed. It's really a framework that demands patience and forces us to ignore all that daily noise.
And that really leaves us with one final thought. Dow theory isn't about day trading or getting rich quick. It's a lens, a way to see the broad, powerful forces that are shaping our economy. It gives us a framework for asking the most important question of all. Forget the ripples, try to ignore the waves. Which way is the tide truly moving?